Hey everybody, this is Jose Blasco. We are about to start in 30 plus seconds. Let's use this time for a quick sound check. Can I have a quick confirmation so I know you guys hear me, you guys see me, you guys see the screen, and we are ready to go? I guess a quick message on the chat box would do. Just a quick hello, that would be nice. I will also turn on my video stream. Here we go. I'm putting myself here in the bottom right corner. So we have plenty of space for the charts. Very good. So 10 seconds to go, guys. Again, a quick confirmation that you hear me well. So we are ready to begin. Here we go. That's it. We are live, everybody. Welcome to the session. Thank you for that. Welcome to the session, everybody. Today is October 15, 2020. We are getting together to look at the markets from a little bit of a longer term perspective. Normally, when we do that, basically we utilize options as our key trading asset. We look at directional opportunities. We look at non-directional opportunities as well. We look at whatever the market is providing us that is a tradable opportunity with high odds. And that is determined by the methodologies that we use. And therefore, what is key when it comes to applying such methodologies is to be disciplined and not to break the rules. So in other words, today you'll see me, as always, go through market opportunities. I will either accept them or discard them. Normally, I'd rather discard more opportunities than the ones accepted because we look for quality. And once the trades are accepted because they meet the rules, then we go take the trade. If the rules are not met, then we, as I said, discard the trade and move to another market, look for an opportunity, and basically start again with a very disciplined and professional approach. Just to stack odds in our favor, which is our job. Okay, very good. Thank you for that. A grain of salt, loud and clear. Very good. Wonderful. So, guys, only one thing is left before we start, which is that you read the disclaimer. So I am highlighting it for you guys. Please make sure you read it carefully. This is important information. It is absolutely key that you understand the message behind the disclaimer, since in the end, trading is business. So we are all responsible for what we do. For sure, the opportunities that we'll identify in the market are going to be valid from a methodology point of view. But then executing those trades or not, of course, that is your decision. Using real capital or not, that is your decision. Using a small size or a larger size, of course, you decide that. Okay. Common sense, but of course, something we need to say before we start, especially for the ones of you that have less experience, that are newer to the markets, where you may not have thought about it. And it's important that you realize that this is not a joke. This is real money in the markets. And therefore, we better approach it as a business because while it could be a hobby, when we trade, it's business time. Okay. Cool. So let's go for it. Let's begin the session. And as always, I want to look at a few things first. So I want to look at the market. So I have the S&P 500 ETF, SPY. So we'll start looking at the market from that angle. From there, we'll move into the VIX to understand what's happening with the options. From there, we'll move into reviewing the other trades that we already have running in the accounts to see what's happening to those trades. And finally, we'll get into identifying more opportunities, which is, of course, the most important part of today. Okay, so very quick. S&P, today, after very, very powerful moves to the upside that we had, since a few days, and especially today with a gap down, the market is on the way down by 1%. It's been more than 1% earlier in the day, but right now it's around 1% down. Okay, so again, let's say a little bit of a normal movement in the market, nothing too major in any direction, but certainly interesting to see how on-field orders to sell are showing up in the market. We didn't have any of those. Just a few days ago we didn't have any, and now we have two. So certainly this is something that we need to be very careful and not to be hopeful. If you are in any trade that is directional and you're riding the market to the upside, make sure you have thorough price points where to take your profits, because when price reaches those red UFOs, you may have a collapse, okay, until you get to the next green or the next green UFO, until you have, a bounce, okay? So we need to be careful not to be caught on the wrong side of the equation, okay? Before I move to the VIX, I almost forget, I was saying last week when we met that auto climate was a little bit stretched, okay? Right now, auto climate is pointing at 13 candles into what a normal climate to the upside would be 11. So certainly we reached, a point where the climate is tired, okay? based on probabilities. And it's probably the reason why the market is falling hard, because there is a lot of profit taking after such a nice move. And again, that profit taking may simply lead to a correction and then going back up. If the market was to go down, statistics suggest the duration of the market going down would be 4 candles. Okay, so the market is supposed to go down for a bit and then go back up in the daily time frame, as you can see. But again, sometimes statistics will stretch themselves. Okay, like it happened here, for example, where we had more than 4 candles. The move to the downside was quite exaggerated. And again, this could be the case. It could certainly be the case. Okay, 2020 is one of those years where certainly, the market is showing violence and in many occasions. And as traders, more than ever, we need to manage our risk. Okay, we need to be ready to enter the trades when it's time, exit the trades when it's time. No procrastination, and certainly no hoping. Okay. Now moving into the VIX. Okay, moving into the VIX, which represent the pricing of options. So you can see how last week when we were in the session together, we were looking at the VIX around 25. There were no green UFOs on the VIX at that time. Okay, there were no green UFOs. Everything was red UFOs. That would point at the market going back up, and the market went up the whole week, if you wish, until we reached yesterday and today, where the market are finally going down. And as this is happening, notice how green UFOs are happening in the VIX, and we are now trading at levels of VIX 28, 29, which again is going to make it nice for us to begin our session today, like we did last week, with looking at non-directional opportunities, which basically means selling options. Okay, options that are expensive, actually options that are about to get cheaper. Okay, this is actually the perfect time when to sell options, when you get to a red UFO. Okay, so we don't need to be that precise, to be honest, but certainly it's a good one to see. Okay, so we understand better what's going on in the marketplace now. We understand better what's happening to the prices of options, and the fact that we're going to start looking at opportunities and option strategies where we are going to be sellers of options, not buyers, because they are expensive. So we sell them. And before we begin with the planning, so again, we need to review a few trades. So let me review Nike. Also, I would like to load Option Station Pro. This is a trade I've been commenting on since July 10. And this is probably the worst trade of the whole year, because it's one trade that went all the way against us. Okay, but again, it's a great example to show first what portfolio diversification means and does for us. Second, the beauty of options trading, where when you take a trade, and in this case, this trade cost us $385. This is the trade on Nike. Okay, that was a put, by the way. Let me expand so you can see. Okay, so it's a put that expires tomorrow. So you can see we have 1 day left to expiration. Okay, so that put cost us $385. So then what's the most you can lose? $385. And that stock went all the way to the moon. If you were using stock instead of options, you would have lost an unbelievable amount of capital, which is absolutely problematic. But the beauty with options is that the most you can lose is what you pay for it. So today, the loss shows us 382.5. Again, tomorrow when the market closes, the loss will be the full 385, which is the money paid for those puts. So, very bad trade. It went all the way against us, but very good news. We were running this trade in parallel with other trades. Other trades that were pointing to the upside, other trades that were pointing to the downside, other trades that were pointing non-directional. And while this trade went all the way against us, the most you could lose is 385, and many other trades were closed for profits. So overall, as a trader, you were profitable, and this trade was there as a hedge. In case other trades didn't work well, this trade would have worked well. Because this trade didn't work well, it means other trades that were pointing at the opposite direction did work well. And the beauty with options against is that the most you can lose is what you pay for the option. So it doesn't matter how far the stock goes, the loss is limited without the need for stops. Okay, so that's a very powerful thing that we put together in our accounts. Okay, so anyway, I guess that this is gonna be the last week I comment on Nike, since the options on Nike will expire tomorrow. So goodbye, Nike. Now, FISV. Okay, this is another trade that we have on. This trade will conclude tomorrow. We entered this trade on July 27. This is a non-directional trade. And basically, we were relying on UFOs above and below, and we set a range from 113 to 85. And we said, okay, we expect the market to remain between that range. and that is using a expiration date of October 16, which is the vertical line you see there. And if I was to zoom in, I guess it's quite obvious, but we are almost where the vertical line is. Okay, so this is today, okay, and the vertical line is tomorrow. So again, is it looking like we're going to stay in the purple area from, if you think about today and tomorrow? Well, certainly it looks very, very, very extremely probable that this trade will end up with a full profit. As discussed before in other sessions, when doing non-directional trades, it is a common practice to collect profits before the expiration date. Okay, so you basically have two ways to approach this, which is to be dynamic on the trade management and either close the trade ahead of time or reconvert this iron condor into other option strategies in the middle of the process to mitigate problems. I'll show you an example of that later with Beyond Meat, okay, which is a stock that was problematic at some point. But another way to deal with these trades is basically to close your eyes and just wait until the expiration date. And this is kind of like my approach at this moment in time in the channel, which is to just do the iron condor and leave it alone. Okay, not because that's my favorite way to deal with non-directional trades, but because from an educational point of view, I want you guys to see what happens to the life of the whole trade so we can comment. Okay, even though in this trade, to be honest, there was nothing or not much to comment since there was no hiccup. We planned for this market to remain in the purple area, and it stayed in the purple area all the time. Didn't even went close to the upper part, didn't even got close to the bottom part either. So that was a trade where you could certainly leave it alone, and that's it. But again, we'll have to comment in more advanced sessions sometime in the future on other choices that you have to do these trades better, okay, or more efficient, I should say. SPG is same example. This is a trade that we started a bit later. That was September 4, also using October 16 expiration date, which is tomorrow. And notice how it's looking like we will end up hitting that vertical line tomorrow inside the purple area. And that will be another trade closed for a full profit. Okay, Beyond Meat. Okay, this one is a bit more interesting because that one. Okay, let me zoom in here a little bit, or expand. Okay, I'll do both, expand and zoom in. So notice that we were expecting the stock to remain in the purple area, but notice that the stock went above the purple area for a few days, came back in. Okay, came back out again. Okay, thank you, Red UFO. You brought the price back in, and the price is currently here. So again, from today until tomorrow, it is certainly possible for us to end up with a profit in this trade, given where the price of the stock is right now, which is again back inside the purple area. But also what's possible is that something happens, or that's little scare of 2-3 days the market going down in a row, with today the gap down. So maybe that was a great opportunity for larger players to purchase stocks heavily, and next thing you know, we may see that stock rally very hard because of a very intense buying, especially since the on-field orders have been partially used already. You can see this is not a full red color, it's a light red color, meaning that those on-field orders are not fully available. Okay, so again, if I zoom in, you can see how there's been an instance here where price came into the on-field orders area one time, second time, so orders were being filled, that pushed the price down, great, but the fact that orders are being filled also means, it's counterintuitive, but it also means that less on-field orders are left behind. So the app still qualified that zone as a powerful one with a great quantity of on-field orders, and therefore is still plotting it on the chart. If it was not the case, it would not be plotted on the chart. So it's not like this does not exist. It does exist. But at the same time, again, stocks are a fragile instrument. They depend and are heavily influenced by other factors, such as competitor companies, market sectors, the broad market, such as the S&P. And again, if large market players, fund managers, starts buying stocks like crazy, the S&P will rally, and Beyond Meat may rally too, and those sell-on-field orders may be canceled, and we get to see that red circle go away. Okay, so again, we need to always be a bit skeptical, especially trading stocks, because while it's a fantastic market to trade, they are fragile by nature, because you got a market, right, which is made of 9,000 stocks. So if you think about the weight of each company individually, it's quite limited compared to the size of the market. Okay, and that putting on the side, the stock market is like 3 times smaller than futures, for example. So while it's very large, it's not that large compared to other markets. So we need to always have this healthily skeptical mindset when it comes to trading. So if you were to look at Beyond Meat, okay, if you were to look at Beyond Meat, let me load it here in the analysis tab. So right now, okay, you can see the real-time P&L is $17. So of course, it's not a great profit. Okay, it's not a great profit, but in cases like that, really, it's either you make 17 or you could lose. Okay, this trade was made of selling the 105, selling the 190 and buying the 195. So basically, you are risking $500. Okay, so it's either you flip a coin. Okay, one thing is to do it when you're in the middle of the range that you have probabilities on your end. But now if you do it here, since you are so close to the upper part of the range, then you don't have so many probabilities anymore, especially given the fact that the red UFO is outside your defined range, defined by the upper horizontal line, and therefore it's kind of flipping a coin to me. So now it's either, you're having a bet with not necessarily probabilities in your favor, where it's either you make 75 or lose 500, and in this case, maybe a healthy action, I would say it is indeed, it would be to collect those $17 of profit, which is a very tiny profit, but take that money, run, and remove the risk of the trade, because again, you don't have the elements we need to in a way that is convinced to remain in this trade, knowing that odds are in your favor. Okay, so you will want to get out of this trade, even though we'll review it to see what happens, but really that's what it is. Okay, Merck, okay, it's another trade that expires tomorrow, and that one is looking much better. You see the difference. So here we got 2 green UFOs to defend ourselves. So is it possible for that market to go down? Yes, but if it goes down, it's going to hit those UFOs, which are likely going to bring it back up. So being expiration date tomorrow, October 16, which is the vertical line, we are very likely going to see a profit collected on Merck. What about ATVI? ATVI is looking good, even though ATVI, notice that is not using October 16, is using October 23. Okay, so this one, we still have 1 week to go. Notice that it was surprising because we entered the trade here in the middle part of the range, and notice what a crazy move to the outside took place. Okay, thank you, UFO, because you brought it back down. Okay, and with the fear that kicked in recently in the market, we just had a new pile of sell-on field orders coming, bringing the price even lower. Okay, so good news. We are back to have 2 UFOs above. We are back to have 2 UFOs or more below. In this case, 3. So again, the trade looks good for us to stay in, and certainly we can just enjoy it. Okay, when it comes to the P&L of this trade right now, if you were to look at the real-time P&L. Right now is looking like -$3. Okay, so it's looking a little tiny negative. Okay, thank you so much, grain of salt. Sorry. How are you, Yusuf? Yeah, the AutoUFO is fully automatic. Yes, there is a calibration setting to adjust it to your trading style, and when you calibrate it, then it's automatic. Yeah. So anyway, so it's showing a little bit tiny bit of pain, but again, it's certainly looking like all is good with the 2 UFOs above, 2 UFOs below, and next thing you know, let's say you are going to survive tomorrow, which is, I would say, is very likely that we're going to survive tomorrow. Next thing you know, now you get into the weekend, so now next thing you know, you are collecting another 2 days of time decay, and therefore a good idea would be to reevaluate this trade on Monday. And if on Monday you see any sort of danger, probably with 3 more days of decay or 4 more days of decay, which is today and tomorrow and the weekend, you should see this trade to be profitable, and then you can have a decision similar to the one I pointed out with Beyond Meat, if you see any danger, which is to close the trade ahead of time. And yes, of course, you're not going to make the whole profit, but then you would be able to exit for at least some profit, which is certainly appreciated. Okay, cool. Okay, so with all of this said, hopefully all this initial part of the session, which is kind of like an introduction and a review and all together, kind of, So hopefully this helps you to if you are in these trades, to understand what you should do or what you should not do. That's important. But also, hopefully, these reviews are also helping you to understand better the new trades I am about to plan and research for, because, of course, they're going to follow similar patterns and setups. And thanks to the review, hopefully, if you are new to the channel, you're new to the sessions that we do, hopefully that will help you to understand a bit better what I'm trying to do. Okay, and what is the rationale behind the trade setups that I'm looking for. Cool. So again, we said earlier options are expensive. We're going to start with non-directional trades, which are credit opportunities. So let me sort those trades using the price of the stock. And we're going to start with Biogen here as a stock trading at $289 per share. So what do we have with Biogen? Well, with Biogen, unfortunately, we're not going to be able to do a trade. The trade setup is looking beautiful, to be honest. But when you look at earnings, okay, notice earnings are October 21st. Okay, October 21st. And of course, if you look at the calendar, I guess that's obvious, but just in case. So tomorrow expiration date is on the 16th. Okay, that's probably too close. And then if I look for the next one, which is Friday, it's the 23. And of course, earnings are on the 21st, which is 2 days before earnings. Sorry, 2 days before expiration. So then we cannot do it. Okay, because then we are, remember the concept of a non-directional trade is to enter the trade and hopefully enjoy a market that remains quiet. Well, earnings normally spice up price movement, creating gaps, and sometimes not only gaps, but also continuation. So it's kind of like the complete opposite of non-directional trading. So you never want to be faced with earnings happening while you are in a non-directional trade. Therefore, with earnings happening on the 21st, we're going to have to pass. Okay. So moving to the next one, which is Facebook. Okay. And if you don't mind, I'm going to take a sip of water. Thank you so much. Yusuf, okay, thank you. So then I can use it as a strategy in TradeStation. It depends on what you mean by strategy. If what you mean by strategy is your trading strategy, the answer is yes. If what you mean by strategy is the automation that TradeStation provides with strategy trading, where you basically click a button and turn on your strategy and TradeStation trades for you automatically, then the answer is no. Because AutoUFO is designed to be a study in TradeStation, not a strategy, because of obvious reasons. Because while it's a very powerful tool, and let's face it, it will probably work well, but maybe not in every market. You will need to check your calibration results. And also, normally when we trade, the way to stack more quality in your favor will be to use multiple time frames. Normally what we do is we look at the climate, then we look at the UFOs. So it's it cannot be fully automated just by itself. Okay, I'm not saying it cannot be done with technology. For sure, TradeStation is an amazing platform, but it's not how it's been designed by us as developers, as we provide you with AutoUFOs. It's to be used in the context of a methodology, not to do full automation. Okay, cool. So hopefully this answers your question, because again, strategy is a generic word and we may use it both, but we may mean something different. So I wanted to differentiate, okay, between strategy from the English dictionary and strategy from the TradeStation dictionary. Okay. Cool. So Facebook, what do we have? Well, earnings on Facebook are a bit more generous. It's October 29. So with October 29, we have a bit more freedom when it comes to dates. Okay. And we have plenty of UFOs above. We have plenty of UFOs below. We got 51%, which is more than 48%, which is our minimum for non-directional trades. Okay. If I look at pre and post market, 51 becomes 47.88, that is less than 48, almost, but is less. So then that we cannot use. Okay, but certainly 51%, it's something that we welcome. And therefore, our first trade, okay, it's going to be a trade on Facebook. Let's see if we can get a green light, go ahead, or maybe we get a no-go. We'll see. Okay, so let's begin with Facebook. We're going to select the expiration date to be October 23. And then I'm just going to right click anywhere to analyze and sell an iron condor. Okay. And that's how we are going to begin our planning. Okay. My pleasure, Yusuf. My pleasure. Yeah. I kind of felt that this is what you meant, but I just wanted to double check. Yeah, thanks for that. So, so what do we have? Okay, so we have expiration date 23rd of October. So forget about the strikes for now. Of course, they're critical, but right now I'm not focusing on the strikes. Okay, so forget about the strikes. And with that expiration date, we have calculated one standard deviation above and below. So basically, what Option Station Pro is doing for us is grabbing the data when it comes to implied volatility information and projects price movement into the future, being October 23, and is telling us that in a normal case, that stock will remain trading between 251 and 282. Okay, so 251 and 282, where is that on the chart? Okay, 251 and 282 is something like that. Okay, so let's call it 251 and 282. So it's more or less like that. So in other words, if I wanted to do an underdirectional trade, okay, a normal action would be to put my lines here and here, and that would be a valid range from 287 to 247. Why? Because price is in the middle. Okay, price is in the middle, and my protection happens to be 287, which is beyond what statistics suggest. And most importantly, I got 1, 2, and 3 UFOs to defend myself. Remember, the minimum we need is 2. We got 3. Great. Thank you, market. And then same happens below. Our limit below is 247, which is beyond 252. But most importantly, we got multiple UFOs, more than 2, to defend ourselves. So again, we are now expecting from now until next week that Facebook will do whatever it does, but should stay somewhere in the range. Okay, that's the expectation from now until that date. So before I get more detailed in the plan when it comes to the planning of this trade, my key question here is, okay, we don't want to waste time. My key question is how much I get paid for the 287 calls, because we may not get paid enough, or we may get paid enough. If we get paid enough, then let's plan for the next step. But if we don't get paid enough, then we just need to forget about this trade and look for another one. Okay. So 287 does not exist, but we have 287.5, which is good enough. Okay, and notice that this option, I just froze the screen, pays us 64 cents. So what's our minimum? Our minimum is 35 cents. Okay, and that's 64. So certainly we are collecting premium enough. So that's a good beginning. What about in the bottom part? We said 247. Okay, so 247, same thing, does not exist. We got 247.5. And how much we get paid? We got paid 88, which again, it's more than 35. So in this sense, in both cases, the put side and the call side seem to be paying enough. And therefore, it's certainly worth it to continue with the planning, because it looks like we may have a go-ahead for this non-directional trade on Facebook. Okay, so a non-directional trade, which is in this case an Iron Condor, is going to be done by buying a call and selling a call above. All of this utilizing October 23, 2020 expiration date. And then below our purple line below, we're going to sell a put. Okay, and then we're going to buy a put below. That's how we're going to do our Iron Condor. Okay, now again, on top, we said we're going to sell the 287.5 call. Okay, and then we're going to buy above the 290 call. I noticed when I looked at the option chain that the strike price increments were $2.5 at the time. We don't have the 288 or 288.5. It goes straight from 287.5 to 290. So we're going to do that. And on the bottom part, we're going to do the same thing, which is 247.5. And then we're going to buy the 245. Okay. So let me show you the option chain. So you see that in case, I saw it earlier, but I didn't comment. So maybe you didn't see, and I want you to see. So let me show you on the option chain. And I see a question in the chat box. So I'm getting there. So you see 247.5 and 245, and then we got 287.5 and 290. We don't have anything in between. Okay, it's $2.5 strike price increment. Okay, so let's see. Question from a grain of salt. Can you do this in extreme short term, like 1 to 3 days? Yeah, and it would be amazing, but normally it doesn't work. And the reason why it doesn't work in most of the cases is because there is a series of reasons. Reason number one, options are priced based on multiple factors, such as time to expiration. So if you got very little time to expiration, the price of the options is very little. And I just said that when we sell the option, we want to collect at least, okay, we want to collect at least, earlier I said 35 cents, right? Well, if you're using instead of a week and a half or a week and 3 days, you use 3 days to expiration, you may not get your 35 cents. Okay, you don't get paid enough. So could it still work? Yes. But now the question is, what if you lose? Well, if you lose, you're going to lose a ton. And if you profit, you may get paid 10 cents, which is very little, especially if then on top of that you add commissions for the execution and everything else. So that's one reason. Okay. The other reason is because as we are approaching expiration, okay, while the options books talk about options pricing from a theoretical point of view, where you are supposed to decay until you get to the expiration date, the reality is that the decay kind of slows down like 2-3 days before expiration. So it's like most of the decay already happened, 2 to 3 days to expiration, and then when you are about to get to expiration, then you may get 1 or 2 cent decay per day, and it's very minor. So again, if you are selling options right at that time, again you have very little premium to be collected because almost everything already decayed. So it's difficult to make it work. Okay, so could it work? Yes, but normally if it works, it's because you're using a very pricey stock. So maybe you're using stocks, $500 a share, something like that. So it may work because the more expensive the stock, the more expensive the option. And the other reason is because maybe something crazy is happening to that company and there is a huge amount of uncertainty and implied volatility built in the options. And that's one unique situation. And then that time it works. But most of the times it will not work well. Again, unless you're using a very pricey market. Okay. Like for example, if you were to do this using same day expiration, okay, so 1 day to expiration, and you were to do it with, let's say, the SPX, which is the S&P index, which is trading at 3,000 over points, right? Or you were to do it with the options on futures, with options on the ES futures, right? Options on the S&P 500 futures index. So yeah, again, we're dealing with market which are 3,000 over points. So yeah, you could do a same day expiration trade, but with options on equities, normally it will not work well. Okay. Same with the puts. Okay. Same with the puts, because in the end, the amount of, I can show you. Okay. Even though, look at the time. Yeah, I think we have time. So let me show you. So if I show you extrinsic value, for example, extrinsic value basically tells you the amount of time value built in the option that is still left. Okay. So if you pick any strike, okay. So for example, current price is 265. So I'm going to go 2 strikes above to 270. So if I go to 270, the extrinsic value is $4.8, right? Now, if I go to 260 on the put side, which is same distance below, right? And I look at the extrinsic value, look at that, is about the same. Okay. And of course, the reason for the difference is because the current price of the stock, I just froze it, is not trading at 265, it's trading at 265.68, which is a bit closer to the call and a bit further to the put. That's why the put is giving you a bit less extrinsic value, and the call at the 270 call is giving you a bit more of extrinsic value. Okay. If you were to do that with the 1 day expiration option, you would see the same thing. If I look at the 270 call, it's giving you 90 cents. If you look at the 260 put, it's giving you 63 cents. So you see, it's kind of the same thing. Okay, it's kind of the same thing. So it's not about how much you get paid for the option. It's about how much time value you collect. Because when you sell options, you sell them out of the money, isn't it? And therefore, there is no intrinsic value. It's all extrinsic. Okay, so that's what you really get. Okay, so of course there is a common understanding of options trading out there, which is true, which is that the puts are normally more expensive than the calls. Okay, so it's true. Okay, but it's because of other reasons too, because puts often got dividends priced in, and of course they have to have a little bit more value in it. Again, there are different reasons for that. But when you break it down and you look at what is it that you collect, which when you sell options is extrinsic value or time value, whatever you want to call it, you saw it's about the same, no matter if it's a call or a put. Okay. So anyway, so let's go for it. Okay, so let's go for it. We're talking about this Iron Condor with Facebook doing 290, 287.5 with the call side, 247 and a half and 245 on the put side. The call has more value than the put, in which I was explaining yes. And that's because the price of the stock is closer to 270. Okay, so if the current price of the stock is 265.78 and I was pointing at the 270, okay, so you are basically less than $5 away. Where if I was pointing at the 260 put, you are $5.78 away. So you are more than $5 away. So because you are further away, you got less extrinsic value on the put. Because you are less further away on the call, you have more extrinsic value on the call in this example, because this is not exactly 265. If this was exactly 265, instead of 265.73 was 265.00, then you would have the same values for the call and the put, because it's the same distance and the same time to expiration. Okay, cool. So anyway, let's build the Iron Condor. Okay, so I'm going to adjust this in the analysis tab. We are dealing with, we said 290 and 287 and a half. So moving to the 290 and 287 and a half. And on the bottom part, we said 245 and 247 and a half. Okay, so that's what we get. And oh my God, we are right there, right there, absolutely borderline with this trade to be accepted. Okay, so let me explain. These are the strikes. This is the expiration date. And if you do this, that's the bid, that's the ask, and that's the midpoint. So my assumption is going to be done using the midpoint. So I'm going to assume that you're going to place an order if you take this trade using the midpoint. And then you're going to wait patiently until you get filled. Okay, because of course, if you do it with market price, you're going to get 31. So we don't do market orders in options. We do limit orders. So a good beginning would be that midpoint. Okay. So now 36 cents. Is that acceptable? Yes or no? Well, remember, our rule is that we want the premium collected. Okay. We want that premium collected to be greater, okay, or equal to 15% of what we call the raw risk. So what is the raw risk of the trade? The raw risk of the trade is the distance between strikes, either on the upper side or the bottom side. And if the distance was to be different, it would be the greatest distance. So the greatest distance here, which is the same, by the way, above and below, is 2.5. So in other words, we want to collect 15% of 2.5, and that's 37.5 cents, isn't it? So if you take 2.5 times 0.15, this is 37.5 cents. How much is this condor paying? 36. So is it a valid trade for us to execute? No, it's not. What else do I need? I need 2 more cents. Okay, I need 2 more cents. So can you still place the order and see if this condor gains 2 more cents and you get into the trade? Absolutely, and you should do that. Okay, you should do that if you decide to take the trade, and of course you need to quantify the risk and decide how many contracts you want. And as we said, these are your decisions. Okay, the risk of this trade. Okay, right now, notice we just got, here we go. We got 38 cents now. Okay, there is a little bit of an implied volatility kick. Okay, and we got the premium we need now, 37, 38. So we may get filled. Is that making sense? 38 again. You see that? So the trade is valid to be executed. Okay, and the risk of the trade, remember, is 2.5. And if you get 38 minus 38, okay, times 100. So basically you have a risk of $212 per contract. So if you do this trade with 1 contract, you're risking 212. If you do it with 2 contracts, you are risking 424, etc. Okay. Notice the premium went down back to 36. So again, the way to deal with this trade is to go ahead and set it at 38, okay, and place an order. The way I'm going to do it, it's going to be a day order. Okay, so 38 cents, intelligent day order. Okay, and I'm just going to place it. So if I get filled, great. And if I don't get filled, by the end of the day, the order will disappear like it's never been in my account. Okay, because it will be expired. It's a day order. It will be gone by the end of the day. But if the market was to add a little bit of implied volatility. Okay, right now the market, since the gap down, the market has been moving higher. But let's say that the intraday traders are going to be taking profits at some point in the session, maybe before going to lunch, which is in a little bit in New York, isn't it? So maybe you have a drop, maybe the market drops by 0.2%, 0.3%, whatever, and that scares people, and there is a little bit of a peak of implied volatility entering those options, which currently have an implied volatility. Let me freeze the screen here. You can see 40, 38%. That's the implied volatility built in those options. Okay, so that may rise maybe to 41% and 39%, and next thing you know, now you get filled on your 38. Now notice it went down to 35 again. If the market keeps going higher, you should expect the prices of this condor to go down. But again, if there was to be a little bit of a scare out there, even if it's just for 20 or 30 minutes, okay, just because of profit taking among the intraday traders, so you should be able to get filled on this trade. Okay, so again, we are borderline with being filled or not being filled. We don't know what's going to happen, but certainly as long as you execute this trade with a minimum of 38 cents, then, my friends, I am happy to say this trade is valid, and therefore I want to document this trade on the chart in a little bit more generous manner. So this is very well understood for everybody as you take this trade, if you choose to take the trade. So we are using October 23. Here we go. Okay, October 23. And therefore, basically, our bet on this trade is for the stock to stay within this range from now until October 23. Okay, so this is our bet. Okay, this is our bet with the strikes above and the strikes below. Okay, strikes above and strikes below. And my friends, this is our condor. So if you want to take a screenshot, I would say this is probably a very good time, since this is also the time to place an order if you choose to take the trade. Okay. Let me see. Okay, no more comments on the chat box. Okay, so can I get an answer from you guys? If you don't have questions for me, how is it going so far, guys? Can you give me a little bit of feedback on how is the session going? Was I explaining this too fast, too slow? Do I need to re-explain something? How are you doing? All of that. Please give me a little bit of feedback. Also, if you are executing this trade, I'd love to hear. It doesn't matter if it's paper money, real money. To me, I'm thinking of educational, and therefore, I am a believer of practice makes perfect, and for sure, practicing your trades is a good idea. And if you are new to options trading, for sure, a paper money account would be very helpful. Of course, it's not the same utilizing paper money than utilizing real money, especially from the mindset point of view, apart from the real prices that you get in an options account with real orders, real prices. But certainly, it's still a good place where to start if you never traded options before. Okay. So it seems that you guys are good. Furman, good to see you, my friend. Going good, going great. That's great, perfect. Okay, so I'm looking at the time, and we got less than 2 minutes left for the session to be over. So really, we won't have time to put together another trade. But certainly, if you have any final question for me, guys, and you want to go ahead and type it on the chat box, and I'm more than happy to take your questions before we conclude the session, if there is anything you would like to ask. Yusuf, I haven't used the options in my trading. You use futures only. Okay, got it. Perfect. I said for years and years and years, options give you options. Okay, this is something that when I started learning how to trade, really caught my attention. I trade everything: forex, futures, stocks, and options, because every asset got pros and cons. Like options, for example, they expire. That could be a problem. Stocks, for example, they pay dividends. That could be an option or an advantage, I meant to say. Futures, plenty of leverage, more than options. That could be an advantage. 23 hours of trading, that's better than options, right? Like Forex, but Forex is not centralized. Futures and options is centralized, so you don't depend on the broker that may cheat you with the prices, right? So again, everything got pros and cons in life, and in my trading life, I trade everything. There is no something better than other things. It depends on what you use it for. So if you were to use options for short-term trading, then I would say futures is better. But if you are using options for intermediate or longer term trading, then I would say options is better than futures, right? So again, it's just like If you want to drive a Ferrari on the desert, well, good luck. And it doesn't mean Ferrari is not a good car, but you will get stuck. If you were to drive an all-terrain in a highway, well, the Ferrari is going to be a better choice. But in the dunes, the all-terrain is actually a better vehicle, right? So, options, futures, stocks, forex, cryptos, it's the same story. Different assets, different characteristics. Just use what you need depending on your goals and your trading styles. And then the way we trade it is the same. UFOs. It doesn't matter what it is. We apply technology to help us with market assessment and have odds in our favor. Okay, that's my philosophy at least. So if you're new to trading options, Yusuf, I see your question there. What's better? So I kind of answered, isn't it? Certainly, give it a try, practice it, study. There are many videos in the sharpening playlist about options. So study a little bit, learn, and you may fall in love with options because they have great advantages. Okay, now they are more complex to trade, so some of you may not have the time or not have the patience to learn it, and it's fine. Okay, but certainly, if you ask me, I love it, and I would recommend everybody to learn options. Okay. Grain of salt trading. You're a fantastic teacher on this subject. You make things clear that have not been explained in another video anywhere. That's very kind of you, grain of salt. Thank you so much for that. You just made my day. I love the markets and spending time with you guys, and this is one of the reasons why. So thank you very much. Certainly very appreciated. Okay, Yusuf, and where is to start learning with options? Well, look at that. It seems that I read your mind. I didn't read your question, but I kind of read your mind. Yeah, the sharpening session, guys. Let me show you. Let me bring very quick our website. Okay, so I'm just bringing our website to the main screen. Okay, tradewithufos.com. I didn't mean to do this one. I meant to do the YouTube channel. Here we go. Muscle memory, I guess. So if I get here in the Furman, I'm about to discuss that actually. So here's the sharpening playlist in the YouTube channel, isn't it? And basically, if you just do a search, okay, so Control F on your keyboard and you type options, you see there are 16 videos related to options. Okay, so now don't shortcut. Okay, again, I told you options is a more complex asset. So be patient with it, guys. Don't shortcut because you'll get in trouble. Okay, and if you don't have the time, just do it when you have the time. But notice that there are 16 videos, 2 hours long, 1 hour and a half. That one is 27 minutes because really, I guess it was part 1 and part 2. Exactly, it's 2 hours. So every video, almost all of them, will be 2 hours long. So be patient. Okay, there is a lot of materials to be learned. There is a lot of very powerful content in here. Take it easy, one step at a time, but don't shortcut. Don't watch video number 1 and then go watch that trade management on video for options because you will likely get in trouble because again options is an instrument which is once you understand is very simple, like many things in life, but at the same time it has multiple moving parts, and if you don't give yourself time to understand and digest that, you may get in trouble. Okay, so you have 16 videos, 2 hours each, about options in the sharpening playlist. Enjoy. Enjoy. And by the way, since we are here on our website, I'll take a moment to also mention that we have a Forex course, changing topic and changing asset, Forex course happening on October 26th. So it's 11 days to go. Sign up for it. This also grants you 3 months complimentary access to AutoUFOs if you're not subscribed yet. So certainly it's a great advantage, and that could be a great thing for you guys. So get in our website, you'll see the pop-up, or go to the join page, and then you can go ahead and click info and registration and be part of the class. Anyway, everybody, you guys take care. As always, it's my pleasure. Stay safe. Keep up the good work. Be disciplined. That's an important one. Be diligent. Okay. Let's not be procrastinators. When it's time to take a trade, take the trade. If it's time to get out, get out. No hope. Okay, everybody? Take care, everyone. See you next week. Bye-bye.